Hi, everyone. Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So here we are on a Friday. Bond market having a rough week. And that was despite stocks seeing a lot of pain of their own for the last 10 days or so. Some of that seasonality, September being a bad time for stocks. But the bigger theme is we're seeing a tug of war between the threat of tapering, which we'll get into in a moment, and the threat of taxes. And right now, the bond market, if you look at pricing here on a Friday, a lot of red candles, right? Red is bad for bonds. We're seeing bond prices move lower. And technically, we broke beneath this orange line, which is the 100-day moving average. It's the first time we've broken beneath the 100-day moving average in quite some time. You got to go all the way back to June, which was not a good thing, a 2-day close. And on top of that, we're breaking beneath this 101 level, which is also the first time we're breaking beneath 101 for the first time in a month. If we close here on a Friday, we shall see. But not a great technical signal. At the same time, the 10-year note is testing its 200-day moving average, which is a material level. If we get above that on the 10-year note, or that would not be very good. But all the technicals go away because next week it is about the Fed and are they going to taper? And so if you look at what's happened in Europe, just over a week ago, the ECB came out, and while they said they're not tapering, they tapered. They're scaling back, quote unquote, their bond purchases, and so the door is open for the Fed to do it. It may not happen at this meeting, but the seeds will probably be planted for one in the future. And what we don't know is how the bond market is going to react. For those folks not in the business in the last 8 years, in 2013, when the Fed last uttered the word tapers, the bond market just sold off violently, as did stocks, because it didn't like the rise in rates. And when I mean violently, the mortgage rates went up 2.5% in the matter of like 6 months. So it essentially shut off the mortgage business as it relates to rates. Now, no telling what could happen now, but what we watch here at MMG is that the Fed has been buying upwards of $100 billion worth of mortgage-backed securities. They say they're doing at least 40, but because of the runoff of the portfolio that they have this massive portfolio of bonds. They're taking the runoff and going back into the market. They're buying about $5 billion per day. So even if they get rid of the 40, which is going to happen at some point, probably in the not too distant future, they will still be buying a ton of bonds. So this is not this is a policy shift that the Fed will ultimately do, but it isn't from dovish to, say, hawkish. It's more from very dovish to just less very dovish. So, but the reality is, as a mortgage banker, it's how you manage your pipeline. And right now, as we head into this weekend, and you could see these lines coming together, I would be very, very cautious with my pipeline into what is probably going to be the most important Fed meeting next Wednesday at 2 o'clock Eastern time. I hope this finds you well. Have yourself a great weekend. Be safe. Talk to you soon. Bye for now.